Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different topic from the world of investment and consider how we can use the principles laid down by the father of the craft, Benjamin Graham, to shed light on the matter at hand. In today's edition, we shall be taking a look at the unpredictable ways the stock market can react to global events. Specifically, we'll be considering the rollercoaster of emotions experienced by investors worldwide since the US presidential elections. From initial jubilation that saw the US stock markets reach new highs to a nervousness several months later about the impact of a global trade war. We'll look into the difficulties faced by investors when trying to price in unpredictable and often unknowable future economic developments, and how the value investor can protect themselves against the sudden changes in market sentiment that crops up from time to time. So without further ado, let's get right down to it. So as ever, buckle up, sit back, and prepare yourself for another lesson in value investment as inspired by Benjamin Graham. The first thing to say here, and I've said it before, this is a strictly non-political podcast. So whilst we'll be discussing the tumultuous events in the United States over the last few months, I won't be passing judgment on the rights or wrongs of the current administration. That way, we can hopefully keep this podcast a happy and harmonious one, free from division and discord. As it happens, we're primarily interested here, not in party politics, but in investor reaction to news events more generally, and how assumptions based on mere opinion, rather than those being grounded in fact, can lead the unwary investor to great financial harm. To begin this little parable, we need to rewind to the aftermath of the knife-edge US election held on the 5th of November 2024. The US stock markets, buoyed by Donald Trump's victory, initially surged to new heights. The general consensus amongst investors was that having a businessman in the White House, one who had committed to tax cuts and in cutting bureaucracy in his manifesto, could only be good news for business and therefore for share prices. Stock price rises were even more pronounced for certain businesses and industries that were thought to especially benefit from the new policies, such as Tesla, Palantir, and Robinhood. These stocks were even given their own classification, Trump trades. Now let us fast forward 4 months and we find the stock market pretty much back to where it started, with the promise of tax cuts and deregulation being offset by the current fears around the threat to the economy through trade wars and through an unpredictable US economic policy. Investors in this instance, in trying to second-guess the direction of the economy, have done what they do time and time again, and are actually quite insistent upon doing. That is, trying to know the unknowable. Trying to foretell the future is always a notoriously difficult endeavour in all matters, but when it comes to matters of the economy, it proves to be practically impossible. Global economics are not well understood, in actual fact, even by chief economists. So any attempt to try and hazard a guess at the outcome of any given policy by a mere stock market investor is likely to end, more often than not, in abject failure. I'm reminded here of a quote attributed to the physicist and Nobel laureate Richard Feynman. He said, "If you think you understand quantum mechanics, you don't understand quantum mechanics." And I think the same here can be said to be true for economics. And just like with quantum mechanics, any given input can often result in unintended and unpredictable outcomes. The former UK Prime Minister, Liz Truss, and our Chancellor, Kwasi Kwarteng, discovered this to their peril when their well-meaning attempts to kickstart the UK economy resulted in economic meltdown. It is because of the simple unknowability of how political and economic policy will work out in practice that investors will do best to forget about this noise altogether when deciding how much to pay for a stock on any given day. It was for this very reason that Graham prescribed in his books that the future should be something to be guarded against rather than profited from. Clearly, investors snapping up Tesla stock at any price in November were trying to profit from future trading conditions yet to be realised because they believed that conditions would alter in such a way that favoured that particular business. But things have so far not worked out quite as anticipated. Value investors, on the other hand, are interested primarily on the facts of the matter, grounded in past financial data. They are not making possible future trading conditions a basis for their decisions in which stocks to invest. This is not to say that future economic conditions will not play a very important role in their investment success or otherwise, but it is a grudging acceptance that how these future conditions turn out in reality is anyone's guess. So the value investor will be left to do the next best thing. They will seek to guard themselves against this ever unknowable future. And they will do this by employing Graham's margin of safety principle. This is the margin the investor will bake into any valuation and demands a significant discount to the intrinsic value of a business and acts as a sort of insurance policy or buffer against things like future trading conditions, as well as other errors or omissions that can creep into any valuation. The nature of the current US administration style means that we are likely to see lots of volatility in stock markets over the coming years, both ups and downs. You'll need to check out previous podcasts to learn more about Graham's Mr. Market, but what can be said of this manic depressive is that the noise coming out of the White House is unlikely to do anything for his emotional or financial well-being. This state of affairs will likely create more opportunities for the value investor when he's in one of his foul moods, especially in the US market where bargains have been hard to come by of late. Not for nothing, I believe, has Warren Buffett's Berkshire Hathaway amassed its biggest ever cash pile of $334 billion, meaning that he is ready, willing, and able to pounce when the bargain opportunities inevitably arise. There is a chance that the noise coming out of the United States at the moment could have positive effects for value investors in other locations too. For far too long, the US markets have been the be-all and end-all when it comes to global stock market investing. This has pushed up stock prices in the US to historic highs and left other stock exchanges around the world, like the FTSE in London, the DAX in Germany, and the CAC in France, almost forgotten about as destinations for global stock market investors. This could alter, however, if investors see added risks associated with the uncertainty connected to the US economy and look to diversify some of their risk to alternative destinations. Prices have generally looked cheap in many of the European markets for some time now, certainly in comparison to US stocks, and maybe this could be the event that finally balances out the huge valuation discrepancies we've been seeing for some time. In conclusion, we can say that investors are better served by ignoring political noise as best they can, not because it's not important, but because little useful can be taken from it. Expected outcomes rarely pan out as foreseen, and for this reason, investors will be best served by following Graham's advice of guarding against future conditions, rather than attempting to profit from them. We've used the incoming US administration as an example because it is recent and in everyone's minds, but these noise events happen all the time, from investors trying to predict the effect on the economy from the war in Ukraine to the financial winners and losers of the COVID pandemic. Each time, these predictions were wrong more often than they were right. Which beggars the question, why even bother wasting intellectual energy on this endeavour in the first place? Whilst attempts to foretell the future seems like a fool's errand, what value investors can do is employ a margin of safety into every investment. This will at least ensure that economic outcomes, as they unfold, should not cause them too much harm. Predictions of better or worse times ahead serves little or no purpose but to distract and confuse. The intricacies of global economics is too vast and multifaceted, even for the best economic minds in the business, to accurately predict how policy or actions will turn out in reality. The future is intrinsically an uncertain one, and those claiming to know better are not investing, they are de facto speculating. Value investors will be better served by studying not their crystal balls, but their business's financial statements. Forget about the microeconomic picture and invest in those businesses whose accounts suggest they will be profitable long into the future and can be bought for a price that is fair. Ignore the noise, those economic forecasts, popular sentiment, the ebbs and flows of rising and declining stock prices, and concentrate instead on the fundamentals. On that note, I will draw today's podcast to a close. If you've enjoyed it, please do consider adding to playlist. That way you'll be notified the moment a new episode lands on your platform. And do spread the word. That way we can make this podcast as big of a community of like-minded investors as possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.